And I'd say a large part of our debate, and there's been happening more recently, is around how we define the economic climate. And that can start as simply as are we in a high growth, low growth, high inflation, low inflation environment. And then from there, we start to have conversations around each country across developed and emerging markets and talk about things like economic factors like inflation, cash rates, long-term yields. We're having a conversation around what our equilibrium views are on those countries. Again, once you've got past the conversation around what's equilibrium, particularly when you've got a couple of mathematicians in the team, you then move to really setting the trajectory from where we are today. Do we see rates higher than where we are today or lower? Are we building in a normalization, which is the end call that we've made? We still do believe that there is a normalization that the central banks are targeting, and particularly from history would suggest that we should see a normalization over time. The real question that's come in the last few months, particularly as the Fed has pivoted a little bit in early 2019, has been around the convergence of that equilibrium and slowing that down. And that has sort of significant impacts for things like bond returns as you sort of change that convergence to an equilibrium level as to how soon you might expect a negative return in bonds. So that really then shapes your fundamental view as to how you shape your allocations. And that's really probably the biggest debates that we've been having right now. So as we talk about markets today, we've been discussing the fact that there's high valuations both in equities and bonds. I think what we'll firstly find out in 2020 is who's right now. Bond markets are basically predicting for a recession coming forward, and equity markets are continuing like the cycle is going to continue forever. So that'll be the first thing that we're looking for, and the way in which we'll discover that is looking very closely at the fundamentals, particularly around some of the economic numbers that are potentially being impacted by sentiment from conversations around trade wars. The trade wars are going to be an ongoing dialogue for a number of months. Up until this point, they've been very much about rhetoric and posturing. I think a lot of people are comfortable with the fact that Trump likes to take a certain position and then capitulate at the end. I think as we come closer to the US election cycle in 2020, there'll be much more pressure on Trump to actually deliver on something. So it'll be very important to keep an eye on how these discussions play out over that period. And then I think more broadly outside of markets, a theme that we're finding a lot with our client discussions is responsible investing. There are a lot more conversations now around how do we actually implement this in our portfolios. Up until this point, people have been understanding the benefits of it and why it's important. How we've implemented it so far has been really around things like exclusion of tobacco, exclusion of munitions, which is a very first step that you can do in a multi-asset portfolio. I think some of our investors have allocated to ESG strategies in different sleeves of their portfolio. One of the challenges there that actually they have potentially contradicting views to how they're approaching ESG. One of the things that gives me a bit of comfort in how we're approaching it is because we build everything directly ourselves, I think we've got the opportunity to continue to reflect these views as they become, I guess, more thought through and in how we can better reflect this in a multi-asset portfolio.